wish. Uh, Good evening, everyone. We're just going live here. We're going to have Andre from Brazil. Andre, welcome to the live stream. It's nice to have you today. How are
Good to
you?
be here.
Great.
Fine, thank you.
Good. Let me just do something here. Hold on. Rudy's here as well. He was asleep on the floor, but I think he wants to say hello to everyone. There's quite a few of you here already. Uh, Say hello, Rudy, and you can go down now. The topic for today, Andre, and the viewers is rough seas for markets and economy as yield curve uninverts. I mean, and we were talking before we went live. There's so many other things happening as well, but we'll focus on this first. Maybe later on when Clive is on, we can also talk about a lot of other things, and we'll also answer people's questions. So, Andre, before I usually come in earlier and say hello to everyone. So James Richter's here. Quadman72 says hi, Rudy. Daryl Ruffley says good morning, all. I guess he must be in Australia if he's saying good morning. Belly Dance Arabia is here. Andrew Rama, Darren Smith. Over here is here. Echo Echo. Darren Smith, Patty Jones, Michael Kennedy, Gavster Legrand is here. So Dutch Libertarian. So Andre is in Brazil, and he was talking to me about what's going on in Brazil politically, and it's interesting. Maybe we can talk a little bit about it because I saw that Trump yesterday said that he's gonna punish countries that don't use the dollar, even if they're not trading with the US. And I think that's shooting yourself in the foot again. I don't think it will work. And you tell me that what's going on in Brazil is a little bit the globalists trying to get Brazil to side with the globalists and not BRICS. Is that what you think?
Well, from where I see, the local press is already claiming Lula should have a harsh position against his ally in Venezuela, Nicolas Maduro. Lula has been trying to dodge. Oh, here we have Clive. Hi, Clive. How are you?
Hey, good
Hi.
evening, Andre.
Good to see
Good
you.
evening, Mario.
Hi, Clive.
Oh, I was about to talk to you, to Mario and the audience about what's going on in Brazil. Uh, well, look, the way we see things here in Brazil is that they the system, the Western countries, they rallied behind Lula. They got the Vice President Geraldo Alckmin, and they put him in power. Uh, Similar stuff that the US has been doing around the globe. I'll leave it at that. And there's a strong situation on a geopolitical level where if there's conflict between uh, the global south, so-called global south, and 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 the Western countries, the Western bloc, Brazil is a pivotal element in this dispute because the natural resources, minerals, food, all sorts of things. So to me, it's starting to look like this thing with Alexandre de Moraes is just an item to an end. What I'm trying to say is uh, the White House, the Biden White House, is putting a lot of pressure on Lula, as if to send a message: you belong to the Western Bloc. Don't think for a moment that you can align yourself with the likes of Russia and China. and we're coming for you. And it is not my opinion that there's documents and bunch of letters and all sorts of communication between officials in writing, sending this clear message to Lula. Okay? Lula had to withstand certain comments from Maduro when Lula was pressured to get rid of him. Lula refused to get rid of Maduro. He thought he could play both sides. Maduro went after Lula in a big way. He said the same ballot, uh, the same ballots that got me elected here got you elected in Brazil. He said that in public. So they started going at each other. What I'm trying to say is, depending what kind of black swan we get from here until election day in the United States, 56 days away from now, there might be some sense of urgency, whereas Brazil has to pick a side and it has to be with the Western Bloc. Okay. So there's a real strong possibility that, depending how the geopolitical landscape evolves from here until November 5th, that the system who got Lula in the presidency might choose to get rid of him, and that would not be hard. Just for an example, yesterday Lula had to go into the Independence Day ceremony without one single person in the crowd in Brasilia, and at the same time, there was 2 million people in Avenida Paulista in São Paulo. So for the Supreme Court to revive some kind of legal claim against Lula, put it up for voting in Congress and getting rid of him, I bet you the population would not oppose this. But the thing is, who would inherit Lula's chair would be Geraldo Alckmin, who happens to be the godfather of sorts of Alexandre de Moraes. Alexandre de Moraes, who was nominated to the Supreme Court by Michel Temer, who was the inheritor of the Dilma Rousseff impeachment. So this picture fits pretty well. And last but not least,
the vice president, Alckmin, he's also, you said he's a World Economic Forum guy, right?
Yeah, he's from the system.
Yeah.
The anti-systems that we know of are both Bolsonaro and Trump. Okay, these are clearly anti-system. The system hates these two guys.
Yeah.
There might be some other names out there, but anyways, just to bring the point home, drive the point home, if Trump gets elected, if there is an election, it's going to be worse for them. So I think from what I see, the likes of the economists, the economists printing stuff about Brazil, complaining about lack of freedom and all sorts of things. That's quite uncommon. The Biden administration actually was the what's the word? He was the avalista for Lula's presidency. And now that there's some problems on a geopolitical level, I think they might have to get rid of him in a hurry, but we shall see. We don't know.
Okay, that's very interesting. Clive, I wanted to start and ask you if you saw this. I think it came out yesterday. Yellen says no red lights flashing as U.S. makes soft landing. So this is a bit worrying. This is the woman who said when they started QT, I think it was 2016 or something, she said it was going to be like watching paint dry. And then you had the repo crisis in 2019. What do you think? And we're going to look as well at some indicators that might be showing that Yellen might be colorblind. She doesn't see any
Yes.
red lights. So what do you say, Clive?
Well, I don't want to be alarmist for your viewers, but I do think that there's a possibility we are either in a recession or heading very rapidly into a recession. And I'm looking at the latest job numbers, which came out. We had the report about a week and a half ago when they said that all the job numbers they'd been giving us for the last year were completely fake. And they didn't use those words, but basically they said the numbers were about 1 million less jobs than they claimed. And then I saw the jobs report of Friday, which came out Friday morning and moved the market down by about 1.7%. The market sort of, I was kind of expecting a bigger move from the market, but 1.7 is still a relatively large move downwards. That number, which came in, they were expecting 160,000 jobs. We got 142,000 new jobs officially. But the only reason we got 142,000 jobs officially is because the number that they used last month is no longer being used. They've taken last month's number and reduced it significantly, which brings the number of jobs that they're claiming have new jobs that they're claiming to have been made down to 61,000. Now, to put that in perspective, there's several 100,000 people coming into the United States, or the United States working population is growing officially, should be growing officially by 200,000 a month, something like that. But when you look at those numbers, that revised number, and I'm giving my revision because they've fudged or changed the previous month number to make this one look so much better. I now see how many of those 61,000 jobs are government jobs, and there's 37,000 of those jobs are government jobs. So more than 1 in 2 of the new jobs created were government jobs. And of course, by next month, they're going to revise this month number down, which means we haven't got any new jobs at all. So I think the market is taking these non-farm payroll numbers a little bit too much at face value. We've had virtually almost every single month over the last year when they brought out the number, they've revised the previous number downwards so as to make the present month's number look that much better. Now, that could be pure randomness, but I can tell you if that happens 9 times out of 10, as seems to be the case, that's less than 1 in 100 chance of that happening. We're not in the realms of probability here. So I kind of think they're fudging the numbers. But you can see, in any case, what the real numbers are on the very same website and in the very same report if you only bother to look. And I did have a look at the real numbers. So what I see, if I look at the report which came out Friday morning, is that over the course of 1 year, they've created roughly 500,000 new government jobs, which is a positive number for the jobs number. Except when I look at the official numbers, the household report, not the non-farm payrolls report. If I look at the household report of number of jobs, it tells me that the labour force over the course of 1 year has increased by 700,000 jobs, and that sounds like an accurate figure. But of that, 486,000, nearly 500,000, were government jobs, and the population in the same period increased by 2.4 million. So we've got the population going up by 2.4 million, only 700,000 jobs being created, of which 500,000 are government jobs. That leaves 200,000 jobs. So that basically means only 1 in 10 people who increased the population got a job. So it's pretty awful, if you ask me. And if you look at the unemployment numbers in the course of 1 year, which really tell you the true situation, they've risen by 775,000. And on top of that, we've got 932,000 people who are not classified as unemployed, but are classified as not working. That's extra people. So we've got 1.7 million people more than a year ago classified as not working, either unemployed or just dropped out of the labour force, compared with a population growth of 1.6 million.
Yeah, and usually every month the US economy has to create around 200,000 jobs to keep up with population growth. And you're saying it did that, excluding government jobs, it did that in 1 year, 200,000. I mean, that's really, really bad. I wanted to ask you, Andre, about the yield curve because I saw you posted something about that, and I've been looking at it for a while, the yield curve, and it has remained inverted for a long time. And there's a lot of how can I say, misunderstanding. People think that if the yield curve inverts, that means there will be a recession, but it's more like after the yield curve inverts and then uninverts, that a recession is really like dead ahead. And we've seen this week that we definitively went above that. The yield curve now is normal by 6 basis points is not a lot. It could come back down. But what do you think? Do you think this is saying that we're going to have a recession imminently?
What happened? Okay.
Go ahead.
I'm camping with Clive. I think we are already in a recession, and a pretty bad one, which has been camouflaged by government spending and high debt servicing costs, which benefits those who are the rentiers. But I'd say like Wall Street is still doing fine. Main Street America, not so much. One important thing about this uninversion, in this graph, there has been like you're showing like the four prior times where the curve uninverted. We are in a period, in a stage where this uninversion, I'm not so sure if it's already a done deal, because in the prior times we had some head fakes, but let's put it as if we are uninverting from here forward. What caught my attention this time around is in the prior times that we had this curve uninversion, US debt to GDP was not where it is today, about 130%. Debt servicing costs were not almost a trillion, were not $1 trillion per year. The deficit was not growing by $2 trillion a year. So, and the demand for the dollars in the global stage was not under challenge. So if you were to look at what's coming next, you might try to think between Argentina or 1925 UK. Maybe Clive could add some sense to what I'm saying, if there's any.
Well, the one thing I would add about the inverted yield curve and what we now have is an uninverted yield curve. When you have an uninverted yield curve, traditionally that kind of indicates that some sort of growth is ahead, and the inverted yield curve indicates that we're heading into recession. So, at first sight, one might argue, well, we were heading into recession, now perhaps the market's saying we're not. But I don't think that's the case at all. I think the reason we have the yield curve uninverting, in other words, why the 10-year rate is now higher than the 2-year rate, is because exactly the reason you said, Andre. It's the extremely high debt levels relative to GDP that's happening in the United States. It's the high deficits, and people are losing confidence in the ability of the United States to continue to service their debt ad infinitum, and therefore they're demanding, irrespective of whether we go into a recession or not. In fact, a recession would be even more worrying here. But irrespective of whether you go into a recession or not, they're demanding a higher rate of interest for the longer term than for the shorter term, because the risk is that much higher. And if we do go into recession, of course, the risk goes higher rapidly, because the tax receipts will fall, which means the deficit will get wider, which means the debt to GDP ratio will rise at a faster pace, which means the risk is going up, and therefore people are going to want a higher yield. So I think in all the circumstances, we're going into a sort of normality of what people expect. They want a higher rate for investing the money longer term with the government because of the higher risk.
Yeah, so you're saying we could invert again, but it doesn't matter. We'll still have a recession.
I'm sorry.
Yeah.
Sorry, go ahead, Clive. No, I'm
Well,
100% with Clive. We're going to uninvert for the wrong reasons. It's not going to be like a recession where bonds are safe, people bid up the bonds, yields go down, we get some easy liquidity conditions, and things recover down the road. We're in uncharted territory for the reasons that Clive just pointed out. Who's going to buy the bonds? External players are on strike in buying US bonds. The US printed too much money, entered into too much debt. People don't believe in the inflation numbers. So these bonds are a weapon of wealth destruction. That's what they became. So as the recession kicks in and this bond yield curve disinverts, what people are telling, what the message the market is telling us, according to what Clive says, which I agree, is that we're not buying bonds at 3%. We're not buying bonds at 2% because it doesn't add up. I'm going to lose money over time because real inflation is not going to cut it. I'm not going to sit on 2% yields where inflation is 4.5. Real inflation might be even higher.
Yeah.
So the thing here is, I guess, the antidote for this situation, think about it. If you have a recession, which I think we have, the next shoe to drop is going to be tax receipts. Most notably, capital gains tax, which stem from prices in Wall Street, which are still quite high. And then you're going to have more outlays for Social Security related expenses because of the recession. And that will force the Fed to print money. It will force the Fed to print money because he's going to have to issue 10 to 20-year bonds at a rate at which people would be willing to buy. Go ahead, Clive. I'm sorry.
Well, I just going to comment on your capital gains tax thing. I think we've heard Kamala Harris say that she wants to introduce a capital gains tax for those who've got more than 100, I don't know, it's 100 million of assets or 100 million of gains. But the bottom line is this would be a tax. What's being proposed here is a tax on unrealized capital gains, which is a bit of a nonsense because you can imagine, let's say I invent a new company, I go on Wall Street and I now suddenly got a company worth $1 billion. And next year, my shares are worth almost nothing because I didn't do so well. And my capital gains tax bill is going to exceed the value of the shares that just floated on Wall Street. Where's the benefit to the world in that?
Yeah.
Everything becomes uninvestable.
Yeah.
People will not buy.
Becomes uninvestable.
Yeah, people will say, I'm not doing it anymore. I'm not going to be a capitalist. It could bankrupt me.
Yeah. I wanted to switch over now, and this is a bit related to the what Andrea was saying. Who's going to want to buy treasuries that yield 2 or 3%? And I think foreigners definitely are changing their mind about that. And there was I did a video last week about this Russian announcement that they're going to be buying like how many a ton of gold a day for 30 days. So like they multiplied their buying by 6 times. And this came out, I think, recently here, BRICS Summit, October 2024, rumors. And this is from James Anderson. I think he's from SD Bullion. And he posted this from the Russian news agency TASS, and it says here that this is from I think the head of financial services on the BRICS Business Council. He said he confirmed that a list of projects has been determined which in a common unit of account, a unit, a platform for international settlements in BRICS digital currencies. I think that's mBridge. That's even like been developed with the BIS, a payment system, a settlement depository clearing, an insurance system, and the BRICS rating alliance. And apparently they're going to agree on this. And this unit, it says here, assumes the value of the common unit of account is pegged by 40% to the value of gold and 60% to a basket of national currencies of the BRICS countries. So this is interesting that it came out a few days after Russia is going to increase their buying of gold. I think their reserves right now are 30% gold. So it looks like they want to get to 40. And then we get yesterday this comment by Trump. Where is it here? Have I still got it up here? But oh yeah, Donald Trump threatens 100% tariff on countries that turn away from the dollar. So it all seems to be heating up. And I think, sorry, I got the wrong. Yeah. So I think the main beneficiary, in my opinion, is going to be gold. So I'll start with Clive and see what
Yeah,
you.
I'm just laughing at Mr. Trump. You know, anybody saying that unless you use the dollar, we're going to tax you heavily, that's absolutely a sign of desperation. Does he know something that we don't know?
I
Um,
agree.
I'll also comment on the task report and the creation of an alternative currency. Obviously the Russians are in a spot of bother at the moment. They can't do anything in dollars, full stop. It's absolutely out. They can't do anything in dollars. So they want to, they're trading with China and they are selling stuff to China, and China wants to pay them with renminbi, but the Chinese banks are terrified of paying any Russian bank with renminbi or anything else. So the problem which is happening now in Russia is that the Chinese banks are delaying their payments of renminbi, which they owe to the Russian companies, because they're frightened of the US sanctions. The Chinese banks don't want to be cut out of the dollar system, quite obviously. So if at some point they can create some sort of alternative system which isn't subject to the American sanctions, that would suit the Chinese and Russians. But I think it would suit the Russians much more than the Chinese.
Yeah, and you sent me this article, Clive, about Russian lenders. They don't have enough yuan because the Chinese banks are afraid to deal with Russian companies. Maybe they're going to start using gold and just settle payments in gold, but banks are still going to be under threat. How do you think they can work this out, Andre?
Well, I think the technology to run the trade amongst the BRICS Plus is already in place. They're trying to sort out, and the latest information is they're trying to buy a bunch of gold, maybe in anticipation to their meeting that's forthcoming. Other than that, they're trying to come to common grounds between trade flows between these countries. And they happen to think that the next best balance for that trade to starts with 40% gold, basket currencies. I would think that these currencies that make up the rest of the basket has a proportion with, the trade balances between these two countries. I'd like to say something about Donald Trump. If you cannot force Saudi Arabia to sell oil for dollars, if you cannot force people to use dollars in general, there are two ways for you to have them use your dollars. Okay, say you want to go to Disneyland, you have to buy dollars. Okay, but what Trump is trying to say is you want to sell your products in the largest market in the world, you better use dollars, which what he can do in practical terms, you're going to have to buy stuff from us. So you don't think for a second that we're going to buy $100 billion of your products every year and run a 90 billion trade deficit with your country. He's going to be forced into this kind of mercantilism. And not too long ago, the United States was the last country you would think that would do such thing. But that spells inflation, because if you think about this tug of war between the global South and the United States, if Trump were to threaten the likes of China by imposing tariffs, which they're already trying under the Biden administration, China can do the same. China has 300 million middle-class consumers who buy a lot of stuff from the West. So I think the likes of China do not want to phase out of the US in a disorderly manner. They need stuff from the US. The US wants to sell their products in China as well. The US wants to buy stuff that is cheap and better from China. China holds $800 billion in US treasuries in its reserves. China has maybe to the tune of trillions invested in United States. So I don't know. It sounds weird to me that the Biden administration is making threats to China, like the EVs and all these things, because it seems as if it's just rhetorical politics. How this thing is gonna, if you were to live in a normal world, people would have to keep a cool head and sort themselves out and promote the trade. What I think the BRICS Plus are doing that is better than the West is, as opposed to try to hold your grip on global trade and in finance like the United States is trying to do, what the BRICS are preparing for is to have a lot of pain. We might have to, if push comes to shove, we might have to settle our economies amongst ourselves. We might have to boost trade amongst ourselves. I think there's a good chance that we might get there. It might be bumpy because the global South has a lot of commodities. China and Russia are strong military alliance. And China is the manufacturing powerhouse. Russia is the commodity powerhouse. So in case of a global war, you can stop and think about where the BRICS have their own trading systems, financial systems, settlement systems. They have a lot of commodities in the likes of Brazil, Russia. They can manufacture. They have high technology in China. So I have no idea how this is going to play out. What scares me a lot is that the US doesn't understand that it's better for them to have a multipolar world, other than at this very stage, think that they can have the world post-Soviet Union before BRICS Plus. So it's a 5D chess game. But if you look at the BRICS Plus as a whole and compare it with Western Europe, compare it with Japan. Japan doesn't have anything. Western Europe has nothing. They don't have energy. They don't have food. They don't have basic commodities. They will have to kneel to the US. The US could shut down its own economy and they would survive, but not Japan and Europe. And the risk here is, push comes to shove, and I'm going out of the box here, is that the likes of Japan might decide to jump to the arms of China, which makes a ton of sense at this stage. China and Russia can offer Japan energy on the cheap, everything they need to survive without being bullied. But anyways,
there's a lot of American troops in Japan still.
not only in Japan.
I don't see Japan cozying up to China. But you never know. I mean, first of all, the Chinese hate the Japanese, or the Japanese aren't particularly great fans of China. So I don't think that's likely very much. Just on the tariffs, I think it was somebody in your comments just now, Daniel roughly said, who pays the tariffs? Well, it's the citizen of the country which imposes the tariff. It's not the foreign country paying the tariff. If there's a tariff on foreign goods coming into your country, you pay it because you're paying that extra price to buy those goods.
Yeah, it's always the consumer, the taxpayer. Let's switch to the dollar yen, because I think that's talking about Japan like we just did. I think Japan is still an important part of the puzzle for the not just the financial markets, but for the economy. So I've got this, I posted this chart here of the dollar. So this is how many yen that you can buy with the dollar. And back in July, we did made it like a 34-year high. So you could get 162 yen for a dollar, and then the dollar crashed. It bottomed on August 5th, and August 5th was the day the Nikkei dropped 13.5%. The Nasdaq was down 1,200 points in the pre-market, and then things rebounded, but I've been looking at this trend line, and also the technical picture here doesn't look very good, and that's why I put Wile E. Coyote there, because it looks like we could go further down in the dollar. And so I'll let Andre start, and if you can tell the viewers what you think about the carry trade. I've spoken about it for years, but maybe you've got another perspective.
Well, I think I happen to find this chart quite bizarre, and let me try to explain. If you think what's next is a U.S. recession, prices go down, bond yields in the U.S. go down, and the interest rate differential between bond yields in Japan, which happen to be going up, and bond yields in the US going down. What this chart right now, this is a photograph right now, suggests an unwinding of the carry trade, the JPY carry trade. Some say it's in many trillions of dollars. Some claim it was unwound as of a few weeks ago. I happen to disagree. I think there's still a lot of carry trade out there. And this in and of itself could trigger a domino effect in risk assets, because the yen carry trade is everywhere. Turkey, Brazil, you name it. It's been going on for 30 years. So what this graph is saying is inflation came to Japan maybe because of COVID, because of the fiscal deficits in the US, and they're in a position where they need to raise rates. And if there's a recession in the US where bond yields in the US are going down and the bond spreads between Japan and US are going to narrow, and these people are leveraged many times. So these very small moves in interest rates, they trigger margin calls and they bring those JPY home. So this is what this graph is telling us now. Coincidence or not, this crash in this graph, this yen appreciation, came in the back of when people started speculating that there would be many and big rate cuts in the US very soon. But here's the problem. I'm going to pick up on what we were saying about the yield curve and inversion. If there's no one to buy the bonds, you might have a short-term movement that justifies this graph, where maybe the 10-year bond would move from 390 to 375. But once people realize, well, there's a second wave of inflation coming, once people realize that, inflation rates are not going to go down because of the level of indebtedness in the US economy, this graph would reverse violently. because the yen would, the spread between these bonds, as bond yields in the US pick up in order to make up for inflation, like Clive mentioned earlier in our conversation, the spread between these bonds are going to widen big time, much more than it is today, or even before today. And this graph is going to go back to its upward trend and could send the yen to 200. So it's kind of difficult to say, but you might have yen strength in the short term, but depending what happens with the US bond yield curve, because of inflation, for example, and yields must go up in order for people to buy, the yen is going to go down again, which means upwards in this graph. But there's a catch. Depending on the situation, the central bank could come up with yield curve control and allow the yen to live another day. It's the problem with try to anticipate what's next is because there's a lot of intervention in these markets. But I guess you understand my point. This graph shows smaller spreads between US and Japanese bonds, but this might be short-lived. I'd like to say one last thing about this JPY dollar exchange rate. Japan is between a rock and a hard place, okay? If they raise interest rates in order to protect the yen, they're going to run the Nikkei to the ground. If they protect the Nikkei by keeping interest rates low because they owe 230% debt to GDP, and that's just the government, they're going to run the JPY to the ground. So it's not a good look. It's not a good look.
Yeah, according to this, public debt is 302% in Japan to GDP. Clive, you've often spoken about yield curve control. Could you have a situation, I guess, where the Fed cuts rates aggressively over the next 6 months, and then the 10-year yield starts rising because people fear inflation, and then they come in and say, we're gonna maybe do yield curve control or even QE to buy longer term treasuries?
I think it's inevitable, Mario. We are going to get to a point down the line, and I don't know if it's next year. It could even be this year. I think it's quite likely to be late next year, and I think definitely, if not the year after, where due to the rising levels of debt and more importantly, the rising level of interest that the government's having to pay on that debt, that we reach a kind of crisis situation where the yields on government bonds, long-dated bonds, are rising faster than the government can stand. When that happens, the Federal Reserve will be politely invited, read ordered, to step in and do its duty to save the American economy, to save the Treasury, by buying bonds so as to ensure that the yields don't rise beyond a certain point. I don't know what the cutoff point would be. It might be 5, might be 5.5. We don't know exactly where it's going to happen, but it will happen when the government detects that there's not enough appetite to fund its ongoing need for money. So it will happen, but they're not going to let the yields go to 7.5 or anything like that because the Federal Reserve will step in before that. And when the Federal Reserve buys bonds, the way it does that, it prints the money out of thin air and buys those bonds. And let's face it, the Federal Reserve really does need to have a situation where it can get the short-term interest rates down and get a normalized yield curve. That's its plan, and I think we're very much going in that direction now.
Is this, I've just got a chart here of one of our favorite metals, gold, and this is going back to the early 70s, and it's a quarterly chart, and it looks really, I mean, really bullish. And the interesting thing is that there's no euphoria. There's not, people are not talking about it. Do you think, I'll ask Andre first, do you think this is pointing to this gold is saying they're going to have to inflate even more because they need to keep yields down?
Yeah, look, if you look what happened to gold in after 1971, especially when they launched the gold ETF that allowed gold to be adopted institutionally, I'd say yes, a big yes, because we're in uncharted territory. And gold has been the backstop for paper money for forever. So it seems intuitive to me when, not if, this scenario that Clive just described plays out, that people will be buying gold to protect their purchasing power. I don't see gold playing a financial asset role. I see gold playing a protection role, a very important protection role, so that you don't get debased and they will have to print and people will be debased. Everything that Clive mentioned about keeping interest rate lows and inviting the central bank to do yield curve control, that spells inflation. There's no other way to define it. And people will be, even those who don't like gold will have to resort to gold to protect, their purchasing power. They're not going to use gold as a means of exchange, but they're going to certainly, it's going to improve as a store of value. And whichever the expansion of M2, gold will likely follow. The only question mark that I have is to what extent they'll be able to keep gold prices on a leash. And let me explain. Since they broke up the gold standard, they started playing with the price of gold because it's easy to control the price of gold. They have big balance sheets. Gold it's not like something you can carry around easily. It's not easy to store. So they took over the gold market, and they've been doing this for quite some time. The first sign that their control over the gold price is under threat is the BRICS Plus, where the pricing of gold started migrating to China. Okay? So the question mark I have is, will gold keep up with the expansion of money, which it sure will, or worse, will they lose control as they enter a battle for pricing gold between China and the West? Will they lose control over spoofing the price of gold, and then gold may run much more?
I think there's another factor, Andre. I'm sorry, I didn't mean to interrupt. I thought you'd finish there.
I'm done.
And I think that's what about personal freedom. We're seeing the world becoming more and more intrusive in terms of what they know about you, what they want to know about you. Some countries are talking about wealth tax, which don't have it at the moment. And I think we're going into a world where it's going to be harder and harder to have any sort of freedom. In other words, where you're going to have to ask permission almost for everything you do. And I think we'll get to a point where people say, I need to have some gold or silver just so I have a modicum of freedom, which isn't in the control of somebody else. I don't have to have the permission of somebody else to do something. If I want to go and have a bit of fun with my friends and do something, I don't have to ask the government's permission for it, and I can do it with my gold or my silver.
Yeah, I agree. And I think more and more people will probably even start, using gold and silver as payment, and it will be outside the system, especially if they try to bring in CBDCs.
I mean, I'll give you a good example. Let's say you want to have a poker game at home and gambling happens to be illegal for whatever reason, and all of the CBDC, as you mentioned, Mario. Now, you can't have a gambling game unless you've got some money around the table. Of course, you can exchange money with the CBDC, but they're going to know it because everything's going to be documented when you do your CBDC transaction. Not initially, but later on, you'll have to, as you do the transaction, there'll have to be a code with every transaction to say what it's all about. Well, imagine you're wanting to have a game of poker. What are you going to play with? You're going to play with chips, but at the end of the game, money's going to change hands. But if they're going to track that, you're going to want to do it with something which isn't trackable, and that would be gold or silver, as an
Well,
example.
the notion that you have to have better assets is a no-brainer.
Yeah.
Because they're controlling everything. And gold is a better asset in your hands. The notion that this might catch on with the large number of people in the world that will be able to exchange their shit currencies for gold and drive up the prices of gold in comparison with what the big banks can do in the futures market in order to muddle with the price discovery of gold is yet to be seen. In my opinion, for the price of gold to explode solely on this demand for better assets in a world where they want to impose CBDCs is to be seen. Look, if you have to have CBDCs and they only allow you to eat bugs, and you have a gold coin that will allow you to buy a steak, who knows? Huh? I rather think of this example rather than the poker game.
Farmer.
So yeah, but it's going to be a tough world out there, but then you will have your steak. What I'm trying to say is I find it more compelling to think that the BRICS Plus, who do not want to stay hostage to the fiat system, the existing fiat system, might intentionally, meddle with price discovery of gold to rattle the Western bloc. And once they do that, gold is not coming back. What I know for sure, which is not hard, because everything else here we're speculating, is that gold will protect your wealth, that it will. Whichever amounts of dollars that they print, be it to buy bonds, be it to service the debt, be it to fund wars, gold is going to keep up. And as far as having gold in your hands as a bear asset, it is a good thing because depending on the level of financial distress, your money at the bank won't be safe. Like they will give you a programmable CBDC. So I think it's not. This is the best time I've ever seen to hold gold in your hands, because I see zero downside that gold prices are going to crash. Gold is less volatile, and I see a lot of reasons to, and history tells us that once they start to printing M2 expansion, gold is going to go up. You notice that M2 is going up again, eh, Clive?
Yeah, here, the last year is picking up.
And gold is not sleeping at the wheel at all. Gold is performing quite well.
I mean, we saw today that China did not buy any gold in the month of August. It's the fourth month in a row where they did not buy gold. But the gold price, again, this month was hitting record prices. So people or someone or some central bank, we don't know who it is, someone is out there pushing the gold up and up. And that's without the help of what has been the major buyer up until 4 months ago.
I've got the chart of silver here, and it's long-term like gold, quarterly. And yes, silver has been frustrating recently, but I still think it looks quite good technically long term. So what do you guys think?
It's a no-brainer for me. You've got to have some physical silver where you can find it quickly in case you need to spend it. So what I would buy would be coins of the country where you live, which were issued in silver before a certain date. That would be my initial holding. And later on, I'd get into doing what I'm doing much more of, which is collecting the beautiful coins of different collections from Australia or the islands, or the UK's got a beautiful collection called the Queen's Beasts, with about, I think there's about 10, 12 coins in that collection in silver. I think it's a great time. It's a great time to be buying silver. I don't think we're going to see it this cheap ever again.
Andre, have you got a view on silver?
I was thinking about silver under a different angle, which is quite positive, I think, because this conversation about like Western Europe, Japan having no hard assets, no commodities, no energy, and this potential for tons of money printing in the not too distant future, and the applicability of silver in the industrial world, where there's huge demand. So if I were to tell a story about what I think might happen with silver prices, let's say we have a crash. And here's the thing, the market seems to believe that the US looks a lot like Japan, which means there's not going to be a crash. The central bank, the Federal Reserve, is going to print money now because there's so much leverage, so much debt in the system that they cannot even afford to have a crash. If that is the case, all hard assets are going to move, and inflation is going to run wild very fast. So if we were to think about the least crazy scenario, since we are in a fiscal black hole in the US, would be for them to allow for the equity markets to fall, plug in the holes for the banks, allow some deflationary forces to kick in, so they can, after which they can start printing money, except they're going to have to print a lot. And once they start doing that, and the economy starts to run normally, silver is going to show its colors because it has a lot of demand for industries in general. Silver goes into everything. So I'd like to put silver in this hard asset category of things in a world where they're going to print money like there's no tomorrow, as opposed to thinking of silver as a monetary asset. But it's kind of like, it's not a sure thing. It's kind of like, I think they're understating the price potential of silver as an industrial commodity. Because if you think about it, there's going to be a race for energy, for AI, for these GPUs. They use a lot of silver.
Yeah.
And
Last year,
sorry, go ahead.
Sorry,
No, I was going to say,
I just want to, there's a super chat here. Thank you, Chris. And he's got a question. If rates are at zero for a period, but then the market dictates otherwise and say they need to go higher, at what point will they overrun the Fed and do so? What will be the catalyst for it? Thanks. Well, I'm not sure the Fed will be able to drive rates to zero again, because if they do that, the dollar would be toast. But what do you guys think about this?
The Federal Reserve could put the short-term interest rate where it wants to. We saw them do it, and we've seen the ECB and other banks around the world do the same thing. After the 2008 financial crisis, they put the rates to zero or negative in the case of Europe for several years, and Switzerland, of course, was negative too. So that's the central bank. They can do what they like with the short end. The long end, they've got much less control over, because that's a market where there's many people who already hold the power over those bonds, and they can buy and sell those bonds at whatever price they like. So unless the Fed actually steps in which I think is likely to happen if the rates go too high. But unless the Fed steps in, those bonds will trade at a free market rate, which will be higher than zero.
What would trigger the Fed, in my opinion, is what always has, which is the financial system. Okay? So even though their mandate is price stability and jobs, I think they lost control of that a long time ago. And now they have their mandate is to keep a functioning banking system. So we're in uncharted territory, but yeah, I think the Fed will have to do something to plug in the banking system. That would be like something he cannot negotiate. And when that happens, there's going to be all sorts of problems, especially inflation.
Okay, we've got about 5 minutes. Maybe we should take some questions. If you guys have some questions, go ahead and ask. What will cutting rates do? That's someone FUQQ YouTube. I don't want to say the word. Cutting rates, I guess, just creates maybe more liquidity for the financial markets because, yeah, banks and speculators can borrow more cheaply and buy assets. Is that how you guys see it?
Well, there's one more thing that cutting rates will do, and that will be to help the Federal Reserve, who currently, or at least up until now, has been paying out interest which exceeds what it's earning on its portfolio. So if you're a money market fund or a bank and you're depositing money with the Federal Reserve, up until very recently, well, you're still getting above 5% at the short end. But that the problem is the Federal Reserve on its bond portfolio is earning probably only 2.5% or 3% because they bought those bonds 10 years ago when the interest rates were less. So if they can cut rates, they'll turn their situation from making a loss, which they've been making a loss for a year and a half now. They are insolvent, deeply insolvent because of that. It's wiped out their capital many times, not officially wiped out their capital because they've done a bit of monkey business on the accounting side, but it will start to put them back into positive territory. It'll take a year or two to get back there from where we are today, but lowering interest rates will mean they're paying their depositors less than they are earning at the moment. That means they'll start to make a profit eventually, and eventually they'll have covered all those losses. And after they've covered the losses, they'll be able to pay the Treasury their profit as they're obliged to do.
Clive, someone's asking Quadman 72, where's your sunflower?
Well, it's right outside my window, which is you can't quite see it through the window. I gave it a little bit of sunlight because it was looking a bit white.
Someone has a question here. When the crack up boom happens, how long will we have to use our precious metals to make other asset purchases? Well, I would say you'd want to buy assets after the dust settles, after the whole system implodes, and they'll probably bring in some new kind of currency, and I think assets will be really cheap then, and then you jump in. What do you guys think it would be the best time?
I think it's important if you protect your savings in gold and there's a crack up boom because the money printers go mad. During the crash, yeah, a lot of things are going to go on the cheap, but perhaps the price of gold might not suffer as much as equity stocks. But once they run up the money printers, things are going to start to run, and some other things not so much. So what I learned from experience, Mario, is that if you can protect your wealth and you inherit a landscape where things are at a deep discount, you might want to part with part of this wealth, say gold, by buying stuff that you really want and that you really need and that has some perpetual value. So intuitively, your house might be affordable in a situation like that. Certain durable goods might be cheaper eventually. Hard to tell, but I guess it's quite a from person to person.
Yeah.
If I understood correctly.
No, I agree with you. It depends on where you are, who you are, your circumstance. But one thing about the cracker boom and the hyperinflation is that you want to try to avoid selling your gold and silver for to survive. And that's why I've spoken to a few people who have lived in hyperinflation and like in I think Romania and Lebanon, and they say one of the most important things is also having friends and being in good standing with the community. So you might have to barter a lot of stuff, but one thing is the price of gold and silver, or the purchasing power of it, can vary massively from day to day in a complete collapse. So you need to think about that too. So, guys, I want to thank you for coming on the live stream. It was really, really good. And I want to thank the viewers as well for your presence here, and wish everyone a great week. And Clive and Andre, do you want to say a little more, like where people can find you on social media? Start with Clive and then Andre.
Sure. So I'm happy to answer any questions anyone's got via LinkedIn. I also do some Zooms with people who've got particular situations on financial matters. I don't charge anybody. I've got nothing to sell. I don't recommend anybody or even make investment recommendations, but I can tell you if your direction of travel sounds like it makes sense to me or not.
Great. Thank
LinkedIn.
Yeah, LinkedIn, Clive Thompson. You're on LinkedIn as well, Andre.
Yeah,
You
I
want to share with people, or you would rather
well,
not?
no, you can find me on LinkedIn. I use LinkedIn to write and clear up my thoughts.
Yeah,
I like Clive. I'm not in the business of giving financial advice, and I like to use LinkedIn to keep my head straight and my line of thought and keep me updated.
yeah.
And yeah, it was very nice, Mario. Thanks for having me.
You're welcome. And that's how I found you guys on LinkedIn. So yeah, that's good. So it's Andre, JAQU KUBOVICZ, Yakubovich. You can find him on LinkedIn. Uh, okay. All right.